Imagine you are steering this massive cargo ship, right?
Mm.
And it's taking on water. I mean, it is actively sinking under the weight of $172 million in debt.
Yeah, that is a terrifying position to be in.
Right. And you have exactly 12 months to not only patch the hole in the hull, but somehow turn that debt into $130 million in hard cash.
Which sounds completely impossible.
It does. But that is exactly the survival story buried inside the document we're exploring today. Welcome to the deep dive. We are looking at Canopy Growth Corporation's fourth quarter and fiscal year 2026 financial results.
Quite a read.
Yeah, and what looks like, just a wall of gray spreadsheets is actually this real-time blueprint of how a giant in the notoriously volatile cannabis industry is trying desperately to pivot, like going from burning cash to building a highly disciplined empire.
It really is a phenomenal case study in corporate triage. I mean, often earnings reports are just these boring lists of what a company sold, but this one, it's really about what the company had to destroy just to survive.
Oh.
Yeah, we're looking at a fundamental change in their corporate DNA here.
Okay, let's unpack this. Because to understand where Canopy Growth is going and what they are putting on dispensary shelves for you to buy right now, we first have to understand how they even kept the lights on.
Exactly.
So the story basically begins with a massive, aggressive financial cleanup.
Right, because the products almost don't matter at all if the foundation is rotting. If we look at the end of their previous fiscal year, fiscal 2025, that net debt of $172.6 million, I mean, that was a heavy anchor.
Yeah, totally.
In a high interest rate environment, debt like that can just consume a business from the inside out. But by the end of this current reported year, fiscal 2026, they flipped the script completely.
They really did.
Yeah, they reported a net cash position of $131.3 million.
Wait, I want to make sure I'm doing this math correctly. So they went from being in the hole by over $170 million to having over $130 million in cash on hand.
That's right.
That is a positive swing of more than $300 million in a single year. I mean, how does a company even pull that off without just liquidating everything and shutting the doors?
Well, it requires a systematic and, frankly, a very painful reduction of costs across the board.
Yeah.
You see it most clearly in their free cash outflow.
Okay, what were the numbers there?
So in fiscal 2025, their cash outflow was $176.6 million. That's just money hemorrhaging out the door. But in fiscal 2026, they choked that down to $69.1 million.
That is a huge drop.
Yeah. And they achieve this by taking a chainsaw to their selling, general, and administrative expenses, or SG&A. They slashed those operational costs by 6% year over year.
Right, and SG&A is essentially the daily cost of just existing as a corporation, right?
Exactly, the overhead.
So we are talking about headcount reductions, cutting back on third-party IT contractors, insurance, professional fees, all of that.
Yeah, everything that isn't absolutely essential.
If you've ever run a small business or even just managed a tight household budget, you know how brutal this is. It's like when you realize you're drowning in credit card debt, right?
Yeah.
So you sell the broken lawnmower, taking up space in the garage.
Right.
You cancel the premium cable package, and you just stop eating out entirely. I mean, it hurts today, but suddenly next month, the household has actual breathing room.
That's a perfect analogy. The CEO, Luc Mongeau, actually framed this as laying a, quote, disciplined foundation. And their CFO, Tom Stewart, used a phrase I find really revealing. He called it strategic flexibility.
Strategic flexibility.
Okay, yeah. When a company is weighed down by debt, leadership spends like 90% of their time just managing creditors. They are purely reactive.
Just putting out fires.
Exactly. By cutting the bloat, you buy yourself the flexibility to actually be proactive and make strategic moves in the market. But I should point out, that breathing room was not free.
No.
No. They recorded $67.1 million in asset impairment and restructuring costs for the year.
Okay, I want to pause on asset impairment for a second because that sounds like, just accounting jargon.
It is, yeah.
From my understanding, that's essentially a company officially admitting that something they own is just no longer worth what they originally paid for it. Am I getting that right?
You are spot on.
Yeah.
It's basically the financial equivalent of facing reality. A large chunk of that $67 million was writing down the value of goodwill and brands associated with their vaporizer division, Storz & Bickel.
Okay.
Basically, they overvalued it in the past, and now they're taking the hit on paper to clear the books. Combine that with the real-world costs of employee severance and restructuring, and it's a heavy blow.
But the strategy actually worked, right?
It did. Their overall net loss from continuing operations narrowed by 49% year over year. They nearly halved their losses, which finally gives them the runway to actually compete.
Which brings us to the actual business of selling cannabis. So they have this runway now. And you would think, with this new cash and breathing room, they would throw all their weight into the flashiest part of the recreational weed market.
You would think so.
But when you look at where their most reliable revenue is coming from, it's not the trendy recreational side. It's the medical market.
What's really fascinating here is how sharply the numbers validate that specific approach. I mean, in the fourth quarter alone, their Canada medical cannabis net revenue jumped an impressive 27% compared to the same quarter last year.
Wow, 27%.
Yeah, and for the full fiscal year, it was up 18%. This is clearly a primary growth engine for them, not just a secondary side hustle.
A 27% jump in one quarter is massive. But I do have to push back a little on the underlying logic here. Because recreational cannabis gets all the headlines, right? It has the celebrity endorsements, the massive retail footprint. Why double down so heavily on medical? Is this just like a defensive play because the Canadian adult use market is too saturated and they just can't compete there?
Well, far from just playing defense, medical cannabis provides something that literally every single business on earth covets, which is incredibly sticky recurring revenue.
Ah, okay. Sticky revenue.
Think about the psychology of a medical patient versus a recreational consumer. When a patient, especially an insured one, finds a specific strain or tincture that manages their chronic pain or, anxiety,
They stick with it.
they're not looking for the newest thing.
Exactly. They are not walking into a dispensary every Friday looking for the flashiest brand with the cool logo. They demand consistency and reliability. And that creates a massive strategic moat around the business.
Okay, that makes a lot of sense.
Yep.
The switching cost for a patient is just much higher than for someone looking for a fun weekend product.
And Canopy didn't just grow this organically, right? They essentially bought the crown. The report highlights the acquisition of MTL Cannabis, which is the specific move that officially positioned them as Canada's leading medical cannabis company by revenue.
Yeah, they're capturing that market through this really smart two-pronged attack. First, by simply increasing the sheer number of insured patients in their ecosystem through that MTL acquisition.
And the second prong.
The second is launching premium, higher-tier brands directly to those patients. They introduced this brand called Spectrum Reserve.
Spectrum Reserve.
Yeah, this is cannabis flower selected specifically for size, extreme potency, and high terpene levels. They're basically taking premium recreational quality standards and applying them to the medical market.
But, the report also points out a pretty significant hurdle they faced in this space. Veterans Affairs Canada, which I guess is a major source of reimbursement for medical patients up there, they recently reduced their reimbursement rates.
We did, yeah.
So if your core customers suddenly have less insurance coverage to buy your product, logic dictates your revenue should tank. How did Canopy manage to grow 27% in Q4 despite the government cutting the purse strings?
Overcoming that reimbursement cut is honestly a masterclass in pricing power. They didn't just sit back and let sales drop. To mitigate the Veterans Affairs reduction, Canopy had to adjust the actual mechanics of their sales.
How so?
Well, they introduced new product mixes, meaning they offered different sizing options, perhaps bulk options that made the lowered reimbursement dollars stretch further for the patient.
Oh, that's smart.
Right. And they also took targeted pricing actions. Sometimes a company just has to absorb a temporary margin hit on a product to ensure the patient doesn't feel the price increase. That retains the customer long term.
Which proves the revenue is resilient.
Exactly. They prove that medical revenue holds up even when macroeconomic factors push back.
So the medical division is the stable, reliable core. It keeps the ship afloat. But like we said, you can't achieve massive growth targets without expanding. Which brings us to the fast-moving, highly trend-driven adult use sector.
Right. Medical provides the floor, but adult use in international markets provide the ceiling.
Yeah.
In Canada, their adult use cannabis revenue grew 20% over the full fiscal year.
That's solid.
And the mechanism behind that growth is really telling. It wasn't traditional loose flower driving this spike. It was infused pre-roll joints, or PRJs, and new all-in-one vaporizers.
When I look at this data, I immediately think of the convenience store effect.
The convenience store effect.
Yeah. Consumers today, whether they're buying groceries or technology or cannabis, they do not want raw ingredients anymore. They want the ready-to-eat meal. The massive growth in vapes and infused pre-rolls shows that modern cannabis consumers are prioritizing absolute convenience.
Oh, absolutely.
You just rip open the package and it's ready to go. No grinding, no rolling, no setup.
It is the ultimate premium on convenience, but it's heavily paired with an extreme demand for potency.
Right.
The report notes the launch of their new Deelish brand. They are heavily marketing flower with 27 to 33% THC and infused pre-rolls pushing 26 to 32% THC.
Wow, those are staggeringly high numbers.
They really are. The Canadian recreational consumer is voting with their wallet, and they are voting for products that are effortless to consume and highly, highly potent.
And while they're navigating this fast-paced, high-potency trend in Canada, they are fighting a completely different beast internationally, right?
Yes, completely different.
In Q4, their international markets cannabis revenue just exploded. It grew by 68% compared to the same quarter last year. Now, what caused that massive spike?
The report attributes this 68% growth explicitly to resolving severe supply chain challenges in Europe. Because earlier in the fiscal year, they were completely bogged down.
Bogged down how?
Well, it wasn't a lack of consumer demand. It was entirely regulatory friction.
Can you break that down a bit? Because, resolving supply chain challenges sounds like they just found a cheaper shipping company. But moving cannabis across international borders has to be a bureaucratic nightmare.
Oh, it's a massive nightmare.
Yeah.
It's less about finding shipping containers and way more about navigating complex medical-grade compliance.
Okay.
Europe operates under strict EU GMP certifications. That stands for Good Manufacturing Practice. Every single gram of cannabis entering a European country like Germany has to pass rigorous, standardized testing at the border.
Every grain.
Practically, yeah. If a single batch is flagged for, say, moisture content or a slight packaging discrepancy, the entire shipment sits in a warehouse for months.
Jeez.
So Canopy had to systematically fix their internal compliance and documentation to ensure their products flowed smoothly through European customs. Once they unblocked that regulatory pipeline in Q4, all that pent-up demand finally converted into recognized revenue.
Man, it requires an incredible corporate duality. On one hand, you have a company that has to be culturally agile enough to launch highly potent, trendy infused vapes for a fast-moving Canadian consumer.
Right.
And on the other hand, they must possess the agonizing bureaucratic patience to untangle slow-moving, highly regulated European supply chains. Those are two entirely different corporate skill sets living under one roof.
Managing both simultaneously is exactly why their leadership structure needed that disciplined foundation we talked about earlier. If the company is chaotic, you either miss the consumer trend in Canada or you fail the compliance audit in Europe.
Makes perfect sense. So we've spent a lot of time on the turnaround, the medical dominance, the European comeback, but it is vital that we give you, the listener, a fully balanced view of this report because despite all these operational wins, Canopy Growth's overall gross margins actually shrank this year.
Yeah, they did.
There is a lot of pain underneath the top-line revenue growth.
The margin compression is definitely the dark cloud in this report. Their consolidated gross margin for the year fell from 30% down to 24%.
Ouch.
And if you isolate just the fourth quarter, it dropped to a highly concerning 12%.
Okay. A drop to a 12% gross margin in a single quarter is a massive red flag. If you are selling a product for $1 and it costs you 88 cents just to produce it, you are in trouble.
Big trouble.
What caused that plunge? The report points a heavy finger at a $10.7 million inventory charge in Q4. And it says this primarily resulted from reviewing their cannabis inventory right after acquiring MTL Cannabis.
Yes.
Wait a minute. If acquiring MTL Cannabis made them the #1 medical player, why did it cost them $10.7 million in inventory write-offs?
Okay, think about it like buying a successful competing restaurant just so you can get their prime location and their customer base.
Right.
But when you finally get the keys and you open their freezers, you realize they are full of ingredients for a menu you don't even serve. You can't use the ingredients, they're just taking up space, and they are expiring. You still paid for them in the acquisition, but you have literally no choice but to throw them in the dumpster and take the financial hit on day one.
That makes perfect sense. Mergers and acquisitions aren't just about absorbing revenue, you also absorb the other company's operational baggage.
Exactly. When Canopy fully integrated MTL, they found overlapping products, excess biomass, and older stock that simply didn't meet their new discipline standards.
So they tossed it.
They had to write off $10.7 million of that inventory. It vanishes from the value of the company, and that hits the gross margin directly. But it is short-term margin pain for long-term strategic gain.
Got it.
They took the hit in Q4 to clean out the freezer, so to speak, so they can run efficiently next year. The report actually notes that if you exclude that specific write-off, their adjusted gross margin would have been a much healthier 27% in Q4.
Okay, so the core business is healthier than that 12% number suggests. But that wasn't their only bump in the road. We
Correct.
also have to look at Storz and Bickel. This is their premium vaporizer segment, historically a very strong high-margin brand. Yet revenue dropped 14% for both the fourth quarter and the full fiscal year.
It's a tough environment for them.
And they even launched a brand new vaporizer called the VEAZY back in September to boost those numbers, but they still dropped. Why is a premium brand struggling so much?
This really highlights how vulnerable even the most premium brands are to the broader economy. The report cites a few reasons, including comparing against unusually strong sales in the prior year, but the real mechanism driving this drop is macroeconomic pressure.
Like inflation.
Exactly. When inflation is high and consumers are worried about their grocery bills, a high-end $300 luxury vaporizer becomes a very, very easy purchase to delay.
Discretionary spending always dries up first.
Always. Furthermore, Storz and Bickel manufactures in Europe and imports into the United States. The report notes they were hit by increased tariffs on those U.S. imports.
Oh, brutal timing.
Yeah, so Canopy's cost to bring the product into the country went up at the exact moment their core demographic was too hesitant to spend. The VEAZY launch generated some excitement, but it just wasn't enough gravity to overcome international trade tariffs and domestic inflation fears.
So what does this all mean for you? If you were trying to make sense of this massive corporate shift, we have looked at a company that spent the year ruthlessly stripping away excess.
They really did trim the fat.
They cut operational costs, they absorbed the painful financial hits of writing down old assets and dumping messy acquisition inventory, and they refocused. They're building a defensive moat with sticky revenue in the medical market while attacking the convenience and potency trends in adult use.
And their forward-looking projection based on all of this is actually quite bold. Canopy Growth is officially predicting they will reach positive adjusted EBITDA by the end of fiscal year 2027.
Let's clarify adjusted EBITDA quickly for everyone. That stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's a way to look at a company's raw operational profitability, stripping out all the accounting magic and tax start-ins.
Right, the actual core business.
Right. They are saying the actual day-to-day business of growing and selling cannabis will finally generate more cash than it consumes.
They believe this newfound discipline, combined with a full year of these operational efficiencies actually taking effect, will finally push them into the black operationally.
It's a classic turnaround story. They survived the fire, they rebuilt the foundation, and now they're telling the market they are ready to generate returns. But as we reach the end of this analysis, there is one major detail in this report that we haven't touched on yet.
Oh, yeah?
And it might be the most important variable of all.
You look closely at the forward-looking statements toward the very end of the document. There is significant mention of their exposure to the U.S. THC market through an entity called Canopy USA.
Okay, the U.S. market.
Yeah, they are watching the regulatory landscape in America very, very closely. Specifically, the potential implementation of rescheduling medical cannabis from a Schedule I controlled substance down to a Schedule III controlled substance.
Ah, the sleeping giant. But why does moving to Schedule 3 matter so much financially?
Moving to Schedule III isn't just a public relations win. It fundamentally changes the tax code for these businesses.
Really? How so?
Currently, under Schedule I, cannabis companies are subject to the infamous Section 280E of the U.S. tax code. This rule prevents them from writing off standard business expenses like payroll, rent, marketing.
Wait, they can't write off rent or payroll?
No, they can't. They are taxed on their gross profit, not their net income, which creates these crushing effective tax rates.
Wow, that's insane.
It is. But if it moves to Schedule 3, Section 280E no longer applies. Suddenly, they can operate and be taxed like a normal, everyday company. It would completely change their profit margins overnight.
Which leaves us with a lingering, somewhat provocative thought for you to chew on. We have just spent this entire deep dive analyzing how Canopy Growth achieved this massive, highly disciplined financial turnaround by operating leanly and relying strictly on markets like Canada, Australia, and Europe.
Right. They learned to survive on a strict diet.
Exactly. But the ultimate question is, What happens to that strict discipline foundation when the massive U.S. market eventually reschedules and fully opens up?
That is the million-dollar question.
Will they maintain this hard-won fiscal discipline, this careful household budget we talked about, or will the sheer size and hype of the U.S. gold rush tempt them to overspend, overacquire, and just throw all that hard-won discipline out the window all over again?
It's going to be the ultimate stress test for this newly forged corporate DNA.
It absolutely is, and it is definitely a tension you should keep an eye on over the coming year.